We have with us Gautam Duggad from Motilal Oswal joining in on the show right now. Gautam, hi, morning. Good to have you on the show as always. Gautam, one-third of the index earnings still left to go and a whole host of mid and small caps as well. But just wanted you to take a step back and analyze. Because the start has been a little shaky, Gautam, especially with what IT had to deliver. So I'm just wondering, how is it that you've assessed the earnings season so far, and what have been the hits and misses sectorally, firstly?
Hi, Aisha. Good morning. Good to be here. See, the earnings season is just about begin. We haven't yet seen mid cap, small cap, or even so many other sectors are yet to start. We just got IT, which has, 4 or 5 companies have come, and a couple of consumer names, and then 1 or 2 banks. So far things look okay. See, I won't read too much into IT because one tend to exaggerate the impact on a QOQ basis for IT. When you expect 3 and you get 2.8, the market reaction sometimes is quite exaggerated on either side. If you look at things in totality, the expectations were met, maybe plus minus 2% for large cap IT. Mid cap IT has beaten expectations. We have seen some upgrades there. Yes, there has been a concern, and there has been a concern around US recession, potential recession basically, and rate hikes and so many other macro factors. But be that as it may, if you look at the delivery of IT companies over the last 2.5 years, and even the expectations ahead, I think what has happened, however, is in the last 8-9 months, you have seen some derating, right? Earnings haven't seen much of a cut yet. I don't know if we'll see it in the next 6 months, but the expectations are quite modest at about 8 to 10% growth. Interesting thing to note is if you look at the last 5-6 years of tier 1 IT companies, top 5, cumulatively they've made a profit of 5 lakh crores between FY16 to FY22. And out of that, they've returned 3.8 lakh crores. So the balance sheet, free cash flow and payout has been excellent. And with the correction of 25 to 30% in many of these names in the last 6-9 months, I think the valuations are looking quite fair now. You, of course, cannot time when the concerns around potential US recession will go back. So I'm not reading too much into that. As far as the rest of the market is concerned, we are expecting fairly strong earnings as well, about 20% on a quarterly basis for 1Q FY23 and 30% for Nifty. This is obviously getting some help from the low base because last year, same quarter, you had a second wave of COVID. So the right way to look at things will be you look at numbers on a 3-year basis. Pre-COVID, June 19 to June 22 quarter now. On that, you're getting about 20% CAGR for our broader coverage and about 22% for Nifty, which is very good by any stretch of imagination, and which is why our market has been holding so well, especially the bigger indices like Nifty. You've seen just about 7-8% YTD decline. Maybe that would have shrunk to given the rally in the last 2 days. But by and large, corporate earnings have been extremely resilient despite all the macro noise and news flow around commodity and so many other geopolitical events. You closed FY22 at a 36% earnings growth, which is the highest since FY04. And this year we are at about 18% forecast. And so far we have not seen any downgrades in the last 3-4 months.
And of course, later this week, look at the index heavyweights that will be coming out with their earnings. Reliance Industries on Friday, ICICI Bank on Saturday, along with Kotak, and for the first time ever, Infosys on Sunday. So Gautam Duggad, with the news that has come in now as far as the windfall taxation goes, it's a smaller overhang on the big boy Reliance Industries. For the period under review, it's not going to be an impact. But since that's going to be the big number that we will also be watching out for, the numbers will react on Monday. What's the call?
Absolutely. For the quarter, actually, Reliance and ONGC have assumed disproportionate importance. I just mentioned that we are expecting 30% growth for Nifty in earnings. In fact, 62% of our incremental earnings growth for this quarter on a YY basis in Nifty is coming from Reliance plus ONGC. If you were to exclude these 2 companies, my Nifty earnings growth expectation for the quarter shrinks from 31% to just 13%. So therefore, the numbers of Reliance and ONGC have acquired a disproportionate significance for the quarter. We are expecting a number of about 24,000 crores. But things are very volatile, Nayantara. Actually, you've seen GRMs at about 27, 28 a month back. Now they are at 5, 6, 6.5 band. So numbers are going to be extremely volatile for Reliance. And on top of that, you have an added element of government reviewing these duties and windfall taxes every 15 days. So, naturally, the numbers will keep changing. And by the fact, given the fact that these two have about 13 to 14% weight in Nifty index, they will also exert a significant influence on Nifty EPS estimates. For now, we have not changed our estimates after today's action by the government. It is going to lead to ceteris paribus about a 3.5% upgrade from where we are on Reliance EPS for FY23 and about 2% upgrade for ONGC for FY23. But Reliance has seen a very good price correction in the last 1.5 months. So it does offer some upside now on our target prices and our estimates. We have to, however, keep cognizance of the fact that these numbers and therefore the stock reactions will remain very volatile in the near term till things settle down on the commodity price and GRM front.
Good morning, Nikunj also joining in. What could play spoil spot from a 2 to 3 year time frame really could be interest rates. Whether it is home loan rate or whether it is term loan rates or whether it is the rates in terms of at which the corporate borrowing could happen. Are you accounting that in your earning assumptions that interest rates will be moving higher and the impact of that, how will that be captured?
So Nikunj, right now what we are factoring in is the terminal repo will be about 5.5 to 5.75. We are already at 4.9. So we are actually expecting another 60-75 basis point of a hike in this cycle. Now, you're right in saying that the rising rates will of course impact the discretionary consumption and it will bring in so many other elements into the play. The treasury losses, which you're already seeing in the bank's quarterly numbers this quarter. The point, however, to remember is not too long back, which is 4 or 5 years back, you were getting mortgage at about 9 to 10 or 10.5% as well, right? Today, after the increase in the rates, you're still getting at about 7.5 to 8.5, depending on which bank you go to. And in the interim, your property prices have by and large remained flattish. And incomes have grown to whatever extent they have gone at about 7-8% CAGR. So relative affordability for a big ticket purchase item like mortgage has gone up. In our recent channel checks, not too long back, maybe 2 weeks back, with most of the real estate companies and some of the durable companies, we are not so far hearing any concern on the demand side because of the rates which have gone up already and which might potentially go up by another 50 to 75 basis points. As long as rates are below 8.5-9% for mortgage, most of the corporates on the real estate side do not see too much of an impact on the demand which is going to happen. What is, however, going to happen, Nikunj, is these rates will play spoil sport with equity valuations, right? We are at about 18.5 or 19 times now at 16,500 on 1 year forward Nifty. And Nifty Midcap 100 Index, which is the benchmark I use for midcap, is trading at a 10% premium to the Nifty. With every incremental increase in rates, you will keep juggling between the bond equity valuations and relative attractiveness of the equity valuations, as we all know, will diminish. So that is an important element to keep eye on. From a corporate earnings point of view, Nikunj, the balance sheets of the NSE 500 companies are in the pink of their health. The leverage is at a decadal low at about 0.53x, right? This is the lowest in a decade. So I don't expect too much of an impact there on the interest cost side. In fact, corporates with a higher cash element could actually benefit. And secondly, banks, which are largely large cap banks with very good CASA ratio and a good deposit franchise with about 70 to 75% loans linked to external benchmark or variable rate, they will actually benefit in a rising rate environment. So unless we see some dislocation, which is currently not factored in on the rate environment, I don't think there is too much to worry on that front right now.
Gautam, great to have you on the show and get in the perspective on earnings season so far and what the flavor is likely to be going forward as well. Good chatting with you.